Hello everyone, welcome back. Today we're going to start a new module and we're going to go over chapter 6. If you have not read the chapter in the textbook, please stop the video, go ahead and read the textbook first, and come on back. In this chapter, we're going to go over credit scores, credit report, and consumer credit. You'll get to understand different types of consumer credit. You'll learn good and bad reasons for using credit, and also take into account important things that you should consider before taking out a loan. You'll learn the true cost of credit. We'll apply some of the tools that we learned in chapter 5 when we talk about time value of money. You'll also get a chance to obtain and evaluate your own credit report as one of your assignments. Another assignment is to develop a plan to achieve and improve your credit score. Very important is for you to understand your right as a consumer. And an important topic in today's day and age is to understand identity theft and also how to prevent them. Finally, a topic that you may not want to learn, but at the same time is useful to know, is about personal bankruptcies. We hear the term credit all the time, but what is it really? The term credit refers to is an ancient term. In the old days, people can buy goods from merchants before they pay for it, and that is based on the trust that the merchants on the consumers that they will pay in the future, and that is called credit. There are different ways to classify credit. There are 4 different ways. First way to classify is based on whether or not the credit is secured. Unsecured credit is only based on someone's promises to pay. A secure credit means that the credit is backed by some kind of asset. It can be a car, it can be a house, and if payment is not made, then the property that is used as security or pledge will be forfeit and can be sold off to pay off the loan. So a car can be repossessed and a house can be foreclosed. That's one way to classify different types of credit. Another way is to classify it based on whether it is open-end or closed-end. Closed-end credit means that the entire amount of the loan is disbursed. Disbursed means given out when you sign the contract. And you must pay back the entire balance by a specified date. A car loan, a mortgage, those are closed credits. So those are examples. A student loan is also a closed-end credit. A student loan is unsecured. It's only based on your promise to pay. An auto loan, a car loan, is secure. If you don't make the payment, the car can be repossessed. Open-end credit is a loan that you can draw on repeatedly and up to a certain pre-approved amount. And there's no fixed day for you to repay the entire loan. An example for unsecured credit is credit card. So if you have a credit card, you have a credit limit. The credit limit is the pre-approved amount, and you don't have to use the entire amount, obviously, and you don't have a fixed end date for full payment. You may have a minimum payment. You can pay off a certain amount by the end of month. Obviously, the best scenario is for you to make the full payment at the end of each month. A secure type of open-end credit is home equity line of credit. We'll go over different types of loans in individual chapters. You already learned a little bit about student loan. We're going to learn about car loans in the future chapter. We'll talk about credit card in this chapter and also in chapter 7. And we'll talk about home mortgage and home equity line of credit in chapter 9. In chapter 1, we talk about different money personality type, and we saw some examples of some people avoid using credit, avoid using debt at all costs, and other people think that credit is the best thing since sliced bread. So why do people use credit? In fact, the 2 extreme personality are both not desirable. There are good reasons for using credit. You can invest in your future. For example, you may need to buy a car so you can get a better job. You may need an education to pursue your career. Those are good reasons for using credit. Another good reason for using credit is to build a good credit score. If you don't use credit, then you don't have a credit history and your credit score will be low. It can be convenient. Credit card is much more convenient to carry around than cash. And also, if you have a credit history, it can be part of your emergency plan. There are also bad reasons for using credit. If you do not take into account how to repay the debt that you take out in your future budget, that would be bad. The most common mistake of using credit is that it may lead to excessive spending. There are a lot of studies have done in this area. Some have shown that people tend to pay a higher price and spend more when they use credit card instead of cash. And more recent studies show that people tend to buy more when they are using buy now, pay later or BNPL. So both of these are not good reason for using credit because it lets you to spend more money than you originally planned in your budget. And that will lead to accumulating debt unintentionally. So when you invest your future, you're intentionally taking out credit for a specific reason. When you are spending excessively or unthinkingly, then this is unintentional, and that's a bad reason for using credit. So what can we do to avoid that? Now, if you're someone who is already disciplined and you really don't want to spend money, your problem may be to be willing to use your credit card so that you can build up a credit score. For a lot of us, impulse control can sometimes be challenging. The good news is you already have the tools. So first and foremost is to use a budget, and you already know how to do that. Use a list when you go shopping and stick to it. In fact, pick up grocery can be a good option. You don't buy things that you don't need. Another useful tool is to set up spending alert or use the envelope method that we talk about. Spending alert is easy to do with your credit card or your bank account. A tool that a lot of people use is a weighting tool. So you can put something in the shopping cart, or you can even write yourself a note, put it on your calendar and say, hey, I want to buy this. But then wait 3 to 7 days. And in the meantime, consider the following questions. Does the item solve a real problem in your life? So if your computer broke, you need a computer. But just is it because a new model come out? That may not be solving any problems. Will you still use this same item a year from now? Is it worth that? Is this a quality item that will last a long time? Sometimes it's better to spend a little bit more to buy something that will last a long time than replacing a cheap item over and over. Where will it go in your home? Do you have a place for it? For some item, maybe we can borrow it or rent it. I will make a plug for something called a makerspace. I'm a member of one, and I don't have too many tools in my house. Whenever I need to do a project, I just go to the makerspace and use their tools. Your local library is also a good resource. Do you know that a lot of libraries rent out sewing machines and other tools? Some of them even have 3D printers. So there's a lot of things that you might be able to borrow or for free. This is a very important question. If you're using credit, will you buy this item if you have to pay cash, or is it just an impulse purchase? So while you're waiting, answer these questions, and that will help with if your excessive spending is a challenge in your life. These are tools that may help you. Assuming that you have answered those questions and you're satisfied that what you need to purchase is something that is an investment for your future, then we are now in the position to compare different loans. So here are these are the factors that you want to check out when you evaluate different lenders. Origination fee. Many lenders charge an origination fee. This is how they make money in addition to the interest rate. And a lot of times, lenders put this into the loan, and you may not know how much you're paying as an origination fee. The other thing to ask is whether or not there is any prepayment penalty, and also how much are late payment penalties. What kind of interest rate will you be charged? Is the interest rate fixed or variable? If it is a variable interest rate, be sure to check out whether or not what are the caps. So lifetime cap is what is the highest interest rate the variable rate could go up to. This is sometimes called interest rate ceilings. Credit insurance. Credit insurance is money that you pay. So you buy this insurance on behalf of the lender. So if you don't make payment, then the insurance that you buy will pay the lender on your behalf. So you pay the insurance premium to protect the lender. So this additional cost to your loan. The most important question to address is whether or not you can afford the loan. So important to pay attention to whether there are any hidden fees to your monthly payment. So the hidden fees may include credit insurance, late payment penalty, and so forth. These fees may not be disclosed as part of the loan. So the credit insurance is one that typically is not included. Having a budget help. So use your budget to find out whether or not you can afford the monthly payment after all your essential expenses. Oftentimes, if your budget is tight, you may have to make some sacrifices. Are you willing to make those sacrifices, and what will they be in order to afford this loan? Now that you know what to look for in a lender, let's flip the table and ask, so what do the lenders look for in their borrowers? In banking, we have the 5 C's of credit. Bankers use the 5 C's of credit to determine whether to give consumer a loan. Today, most lenders use credit scores and some kind of proprietary algorithm to evaluate lenders. How these algorithms are created and the data they use still basically reflect these 5 C's. The 5 C's are character. It refers to your moral, ethical, and emotional qualities. So in the past, you'll have someone write you a reference letter or a character letter. Capacity, can your income cover the debt payment? Capital, what is your asset and what are your liabilities? So what is your net worth? Collateral, we talk about secure versus unsecured loans. So if the loan will be secured by an asset, that will be used as collateral. The last C is condition. These are the circumstances that are beyond your control. It may be the general economic condition that may affect your ability to repay a loan, and also the lender's willingness to give a loan. So conditions, these are things that are beyond your control. So when the lenders switch to using algorithms, they will have to convert this qualitative attributes such as character and conditions into quantitative measures for the algorithm. Some of this conversion of quality to quantity is relatively easy. Capacity and capital is one. Capacity, your ability to make payment, is oftentimes approximated by the debt to income ratio. We learned how to compute this back in an earlier chapter. There are two common definitions for debt to income ratio. One is you divide your total monthly debt payment, including your rent or mortgage, by your gross. So here's the gross monthly income. And if you're using this approach for the debt to income ratio, lenders look for a ratio of less than 30 to 35%. This is the most common way to compute debt to income ratio. And the option is to divide monthly debt payment, but not including house payment, by your net monthly income. If that is the way you determine your debt to income ratio, lender will look for a number less than 20%. This is less common. To determine your capital, meaning your debt and equity and your net worth, oftentimes lender will look at the debt to equity ratio. You simply divide your total liability or total debt by your net worth. If you own a house with a mortgage, this ratio will likely be very high because most of us put down 10%, 15%, or 20% and borrow 80%. So that will give us a debt to equity ratio of 4 or even higher. For example, you put down, let's look at some specific numbers. If you put down 10% on a mortgage, that means you borrow 90% of the value of the home. Your debt to equity ratio will be 90 divided by 10 will be 9. If you buy a car with a 20% down payment, then you're borrowing 80% of the money. 80 divided by 20 is 4. So the debt to equity ratio for the car is 4. A debt to equity ratio of 1 or exactly 1 means that you have just enough net worth to pay off all outstanding debt. There is no standard number that lender look at for debt to equity ratio, unlike the debt to income ratio. And that is because there is differences between different types of secured debt, a home mortgage versus a car loan, and also unsecured debt. How do we quantify your character? A lot of times the credit score and your credit report is used in its place. The two are very different. A credit report is a report of your credit history, meaning that this is how you did in the past. Your credit history is compiled by credit reporting bureaus. There are 3 main credit reporting bureaus. Their names are Equifax, Experian, and TransUnion. In contrast to a credit report, a credit score is computed by a mathematical model. It is called a scoring model, and it is based on your credit report and other sources. A credit score is used to predict how creditworthy you may be in the future. A credit report is simply a historic record of what you have done in the past in terms of your credit transactions. The most common credit scoring company include FICO, Vantage, and there are a couple of others. And you may have heard of FICO score. FICO score is one of the credit scores. We'll stop the video here. In the next video, we're going to go in details going over what is in the credit report and how are credit scores computed. See you back here soon.